welcome to the Deep Dive. Our mission today is to get into a really dense, comprehensive strategic equity research report looking at the 2026 AI expansion cycle. We're going to distill it down to its absolute core. This isn't just about spotting a market trend. The analysis here argues we're seeing a fundamental global physical transformation.
It's a huge claim.
It is. And we're focusing on two specific companies the report singles out. It calls them the critical non-negotiable toll gates of AI's physical infrastructure.
Right.
So if you're building an AI factory in one of these modern data centers, you basically have to go through these two. We're talking about Vertiv, which supplies the literal life support cooling power in ASML.
The only company in the world that builds the machines to print the next generation of chips. A total monopolist.
Exactly.
And it's a really compelling way to frame it because it cuts through all the software hype and gets right down to the hardware constraints. The report doesn't even call it a market cycle. It calls it an existential investment phase.
Existential investment.
Yeah. If you connect that to the bigger picture, the whole tech industry is shifting massive amounts of capital away from just, experimenting with AI and into the hard reality of physical deployment. The scale of it, well, it needs a whole new level of analysis.
Okay, let's start with that scale because the numbers in this report are just staggering. We are looking at the global hyperscalers, so Alphabet, Amazon, Microsoft, Meta, Oracle, NVIDIA.
All the big players.
All of them. They're projected to spend over $500 billion. That's $500 billion collectively in 2026 alone, just on CapEx. What does that kind of spending even do to an economy?
Well, what's fascinating here is the structural impact. The research points to this landmark moment in 2025 where, for the first time, tech-related investments, so this kind of infrastructure build-out, it actually surpassed consumer spending as the main driver of U.S. GDP growth.
Wow.
Yeah. That's not just a cyclical bounce. It suggests that technology deployment is now a fundamental, structural engine for the whole economy, and it's accelerating right into 2026.
But to build a foundation for a $500 billion deployment, you need stable financing, right? The tech sector has to know that this multi-year build isn't going to get kneecapped by high interest rates or recession.
And the foundation is strong. The report anticipates the Fed will keep shifting toward a neutral interest rate policy. With that neutral rate estimated somewhere around 3.5%, it provides that stable, predictable environment you need for, say, 2.25% to 3% trend growth.
Okay.
But then there's this huge added layer, which is the fiscal stimulus.
You're talking about the OBBBA, the One Big Beautiful Bill Act.
Exactly. This massive fiscal injection, which passed in mid-2025, is now pouring an estimated $200 to $300 billion of stimulus specifically into 2026.
And where's that money going?
Crucially, it's earmarked for modernizing energy grids and beefing up digital infrastructure. So think about that. It's a direct government mandate to fix the very bottlenecks that AI is creating. That is a direct, guaranteed revenue channel for infrastructure stocks.
So the financial capital is there, fiscal policy is pushing it forward, but the grand challenge is still physics. It's the hard limits of power and heat.
That's the core challenge all the spending is trying to solve. The ambition of AI is running headfirst into the constraints of engineering. And the demand figures are, well, they're truly existential. Global data center power demand is forecasted to hit a staggering 9% of all global electricity by 2030. 9%. 9% of the world's power, just for data centers. That is an absolutely unsustainable path without some radical new thermal management and much more robust grid support. And that necessity is why a company like Vertiv becomes so critical.
And you can't ignore the geopolitics here either.
Yeah,
the report brings up this idea of sovereign AI.
Right, and that just adds another layer of complexity that actually juices demand. Every major nation, from the EU to countries in Asia, is intensely focused on developing its own sovereign AI capabilities.
For national resilience.
Exactly, and that means localized build-outs. So you have this intense localized demand for things like cooling and power infrastructure just popping up everywhere, independent of the major trade blocs. It basically guarantees high demand no matter what's happening with global trade.
Okay, let's unpack this and drill down into the first critical player. Vertiv Holdings Co., ticker VRT. The report really emphasizes a dramatic re-rating here, saying VRT is no longer just some industrial provider of, air conditioners.
No.
It's now seen as a high-growth tech enabler.
And that re-rating is completely backed up by their metrics. Look at their scale and their visibility. In early 2026, VRT has a market cap of about $69 billion. But the number that analysts are obsessed with is the backlog.
Okay.
VRT is sitting on a massive $9.5 billion backlog of confirmed orders.
$9.5 billion. That basically guarantees almost a full year of their estimated revenue. The visibility into future cash flow is phenomenal.
It is. But what does the growth rate tell you? Is this just, them burning through old inventory?
Good question.
Well, it's not. Organic order growth over the last 12 months was a healthy 21%. But in the most recent quarter, that growth surged to 60%. 60 year over year.
A 60% acceleration.
Yeah. It shows that current orders are being driven by urgent, immediate AI and high-performance computing needs, and analysts see that continuing through 2026. Operationally, they're executing really well, too. Adjusted operating margin is at 22.3%, and their balance sheet is super clean. Net debt to EBITDA is at a robust 0.5x, which got them a credit upgrade from Moody's.
So when we talk about VRT providing the physical life support, it's more complicated than just running power lines. What are the specific products keeping these hyperdense AI clusters from, well, literally melting down?
Yeah. VRT provides the whole stack, so power from the entry point all the way to consumption and thermal management from the server room right down to the chip. On the power side, you have the Vertiv Trenergy UPS. It's a huge modular power supply built for the massive scale of an AI facility, handling 1,500 to 2,500 kilowatts.
And they're even involved in grid stability itself, which is key if data centers are going to suck up 9% of global power.
Yes, through their Liberty EXL S1 UPS. This system has what they call dynamic grid support. To put that simply for you, it means these huge data centers can actually help stabilize the local power grid by smoothing out fluctuations, instead of just being a massive drain on it.
So it turns the data center from a liability into an asset for the grid.
Precisely.
But the real AI differentiator has to be the thermal management. Air-cooled data centers are basically history for cutting-edge AI.
Absolutely. The heat density of modern AI chips just demands liquid cooling. And VRT's innovation is focused on the coolant distribution unit, the CDU. They have the Vertiv cool chip CDU, which is like the intelligent brain controlling the flow, pressure, and temperature of the coolant that's pumped right to the chips. It's mission critical.
And for facilities that weren't built with liquid cooling in mind,
Yeah,
they have a solution for that too, right?
they do. And this is a major retrofit play. The Vertiv CoolFace CDU is specialized to let those older traditional air-cooled centers easily integrate liquid cooling loops without a massive rebuild. It just lowers the barrier to entry for clients who need to upgrade their existing infrastructure fast.
Before we move on to the services side and talk about ASML, I just want to take a quick moment here. If you are finding this level of specialized detail valuable, like, learning the difference between a cool chip and a cool phase CDU, and if you appreciate this kind of deep dive into the research, do us a favor. Take a second right now to like this deep dive and subscribe to the channel. Your engagement, it actually tells the platforms that high-level, focused content like this is worth prioritizing, and it helps us keep delivering these detailed analyses directly to you. Okay, now back to VRT. They're smart to focus on services. That's usually the high-margin, sticky revenue stream.
It is, and they're doubling down. They acquired a company called Purge-Right Intermediate for $1 billion in late 2025.
Just for maintenance.
Specifically to enhance their liquid cooling maintenance, the really complicated flush and fill services for these coolant loops. That secures high-margin, recurring revenue. Plus, they have software. NextPredict, an AI-powered tool that uses real-time sensor data to forecast hardware failures. Management claims it can cut a client's total cost of ownership by up to 25%.
So Vertiv is clearly dominating this space, but who are they fighting against? Is it a monopoly?
Not a full monopoly, but it's an oligopoly at the top. The report says the market is basically a neck-and-neck race with Schneider Electric. They're separated by just 0.1% market share.
So what's Vertiv's edge?
Specialization. Unlike bigger, more diversified industrial competitors like Eaton or ABB, Vertiv's engineering is almost entirely dedicated to digital infrastructure. This focus just lets them iterate products faster and deliver these specialized AI-specific solutions much quicker than their rivals.
Which brings us to our second critical toll gate, ASML holding NV. If Vertiv is controlling the life support, ASML is controlling the means of production. It's the printing press for the future of computing.
You could argue it's the most structurally important company in the entire tech supply chain. A massive market cap, around $450 billion. They hold a unique, unassailable monopoly on the lithography machines you need to make any advanced chip at 7 millimeters and below.
Mandatory equipment for TSMC, Samsung, and Intel.
Absolutely mandatory.
Okay, for the listener, let's quickly define the business model. What exactly is lithography?
Lithography is the single most complex and expensive step in making a chip. It uses incredibly precise light to literally print these microscopic circuit patterns onto silicon wafers, layer by tiny layer. And ASML makes money in two ways. First, system sales, selling those huge, complex machines that can cost up to $380 million a piece for the newest models.
$380 million for one machine.
Yep. And second, installed base management, which is their high-margin, recurring service revenue maintenance, upgrades, parts. That accounts for a critical 25 to 30% of their total income.
And the future of computing density, especially for AI chips, it all rests on their EUV technology, right? Extreme ultraviolet.
That's the core monopoly. The flagship machine for the sub-2 nm future is the TwinScan EXE.5200B. It uses what's called high NA, or high numerical aperture.
Okay, what is numerical aperture?
Just think of it like the clarity and light gathering power of a camera lens. A higher NA of 0.55 lets them print patterns with 1.7 times more detail than the current systems. It's like going from a standard digital camera to an ultra-high-resolution nanoscale printing press.
And that high NA system just went from theory to reality, didn't it?
Yes. That was a huge narrative shift. Intel successfully installed the very first commercial high NA tool, that EXE.52000B, in October 2025. It's for their upcoming 14A node transition. That move basically validated high NA as the path forward.
So that's the cutting edge. What about the current workhorse?
The workhorse for the current 2nm and 3nm production is the TwinScan NXE.3800D. It's still an incredible machine.
We focus on EUV, but the report notes they have a diversified portfolio. They still use the older tech.
Oh, absolutely. Their DUV or deep ultraviolet systems like the NXT.200 Aruba eye immersion systems are still completely indispensable. They handle the mid-critical layers of advanced chips, plus memory and mature nodes. ASML needs that diversity for stable revenue.
And it goes beyond just printing, right? They also have to make sure the chips are printed correctly.
That's where their metrology segment comes in, which is often overlooked. If you can print at 2nm, you need to be able to inspect for defects that are 5mm or smaller. ASML's tools, like the HMI eScan 1000, use multi-beam E-beam inspection, and they're up to 600% faster at finding defects.
Which is vital for yield.
That's everything for yield. Without perfect inspection, you can't make complex, profitable AI chips. It just confirms their systemic control over the entire process.
Okay, now for the biggest headwind ASML is facing. Geopolitics.
That is the immediate, unavoidable risk. ASML management has warned of a significant decline in China revenue in 2026 because of export controls. And China was a massive segment. It was 42% of ASML's revenue in 2024.
42%, that's a huge cliff.
It is. This China revenue cliff is the #1 challenge they have to overcome right now.
So given that they're losing almost half their revenue, what's the upside thesis? What convinced analysts to upgrade the stock in January 2026? What bridges that gap?
Analysts are betting on what they're calling the 2027 bridge, and it's driven by 3 factors. First, the accelerated 2nm node tool-in cycle. New fabs from TSMC, Intel, and Samsung are buying the equipment now, and lithography intensity is increasing, which means they need more EUV passes per wafer, which means more machine demand per chip.
Okay, so higher intensity.
Second, AI and DRAM. High bandwidth memory, or HBM, which is crucial for AI accelerators, now requires EUV for the first time. This creates a powerful second engine of demand outside of just logic chips. And finally, the economics of high-NA. At $380 million a pop, the revenue mix shifting toward these ultra-high cost machines will naturally and substantially boost their gross margins.
So we connect this all to the bigger picture. We see Vertiv in a volume-driven vertical growth phase, just selling more cooling units, while ASML is in a generational transition phase, moving to the next printing technology.
Exactly.
Both are just fundamentally leveraged plays on the physical infrastructure bottleneck of this 2026 AI cycle.
That's the perfect synthesis. They don't compete, but they represent 2 sides of the same constraint. VRT solves the energy and heat problem, ASML solves the density and capability problem. You need both. But since both companies trade at such high premiums, we have to talk about risk.
Let's start with VRT. That kind of growth rate usually comes with a pretty punishing valuation.
It does. VRT is facing what the report calls severe valuation fatigue. It's trading at around 63 times trailing PE. That's way higher than its historical average.
And that leads to volatility.
Extreme volatility. VRT has a high beta rating of 2.02, meaning it moves twice as aggressively as the market during shocks. And structurally, management has mentioned tariff impacts as a headwind on their margins for 2026.
Okay, and for ASML, the risks are less about valuation fatigue and more about timing and geopolitics.
Precisely. The core risk is still that China revenue cliff. The market has to see proof in the next earnings report that the loss of that 42% is being offset by demand from TSMC, Intel, and Samsung.
And the export controls could get worse.
There's always that persistent export control risk, the fear that controls could expand to DUV or even servicing. And finally, there's customer timing risk. A fab delay from a major client can shift billions in revenue from one quarter to the next, causing huge stock volatility, even if the underlying demand hasn't changed at all.
The report confirms the core finding, though. Vertiv and ASML are the physical limits of the AI revolution, the power grid on one side and the chip printing capacity on the other. They're not just service providers, they're system enablers.
And the market is assigning a premium to that guaranteed execution. That's why you see VRT's 63x PE and ASML's valuation. You're paying for the certainty that if the world is building AI, revenue flows through these 2 toll gates. But you absolutely must be aware of the high volatility and the structural risks you're taking on at that price.
As always, we have to remind you that this analysis is based entirely on the strategic research provided, and you must conduct your own thorough research, DYOR. Do your own research before making any investment decisions.
And this all raises an important question for you to think about. Given the forecast that data centers will eat up 9% of global electricity by 2030, which factor, the heat and power management challenge that VRT solves, or the density and miniaturization challenge that ASML's high-NA EUV solves, which one will ultimately prove to be the most critical, unfixable bottleneck in the long run? Thank you for diving deep with us.